evening, everyone. It is once again Ted the Speed Learner, and tonight I'm going to continue my video series on FASB Statement number 3 to show you how extensive this thing actually is. And I wanted to go into this really deep because if they ever decide, and Congress has been working on this for a long time and they have not done this yet, but if they ever decide to take part of your Social Security and dump it in the stock market, you're going to have to know this. Okay. Now, I briefly discussed the term of retained earnings in the last video, but I wanted to show you how this retained earnings is calculated. Okay? Now, the first thing you should know is that retained earnings are listed on the balance sheet. They're not listed on the income statement. They're actually listed on the balance sheet. And they are listed as part of something called shareholders' equity. Okay? So basically, these shareholders own the company rather than an actual one person. You don't have a sole proprietorship in this case. You don't have a partnership in this case. You actually have stockholders that actually run the company. That's why you have a board of directors. Okay. So how are retained earnings calculated? Well, let's go ahead and show you. So you have, I'm going to show you this in RE. This is retained earnings. Okay, the start of this calculation, well, actually, that's the end of it. Okay, this equals, okay. Now, we have RE again, which is what the retained earnings is at the beginning of whatever period we're talking about. The beginning of the first quarter, the beginning of the second quarter, the beginning of the third quarter, and so on and so forth. Then you're going to either subtract a net loss or you're going to add a net income. That's what NI actually stands for, is net income. Now, what are you going to subtract here? You could subtract one of two things. You could actually subtract a cash dividend. Okay, so what you would do is you'd write a check to every shareholder for a certain amount of money, and everybody would get the same check. Okay, so let's say you wanted to write a check for $44. Okay, $44. So you'd write $44 checks, and you would send them out to every person that owned shares in your stock. And you'd have to send out bigger checks because some people would own more shares of the stock than others, because you're paying $44 a share, not $44 a person. Get the idea? Now, you could also send, okay, or you could send stock dividends. Now, what is a stock dividend? That means you're getting more shares of the company. So what they're saying is that you have a greater ownership of the company because we're sending you more stocks so that you have greater ownership in the company. So what you do is you start with the beginning retained earnings, you'd add the net income, you subtract the cash dividends or the stock dividends, and whatever you had left would be the new retained earnings for the end of the quarter. Say like the end of the first quarter, the end of the second quarter, the end of the third quarter, so on and so forth. Okay, so now you know what retained earnings is and how it's calculated. Why is all this so important? We're going to get into that. So the first question that should come to your mind is, how does it change from FIFO to LIFO, or LIFO to FIFO, or whatever the heck you do? How does the change of this inventory method affect the retained earnings in a company? You have to keep in mind that FIFO or LIFO or whatever heck you're using appears on the company's income statement. Remember, the end of the income statement is where you get your net income, and that's the first thing added to retained earnings. Ah. So, let's go on to what FASB Statement number 3 says, and we're going to go directly from where we left off in the last video. Okay? This statement will also discuss an accounting change such as changing from FIFO to LIFO during the fourth quarter of the fiscal year. So let's say you waited till the last quarter of the year to change from the FIFO method of accounting to the LIFO method. You're accounting for your inventory, but instead of using FIFO, you're now using LIFO. Okay? Accountants were sent copies of APB Opinion Number 28. Now remember, that's the Accounting Principal Board, and they actually published an opinion called Opinion 28, and they sent this prior to January of 1974. After these accountants read this APB opinion, okay, after they read APB Opinion Number 28, they started incorporating these techniques discussed in the statement when they were preparing for their accounting materials for the next quarter. Okay. Now, FASB Statement Number 3 then focuses on paragraphs 23 to 29. Okay, so we got paragraphs 23 through 29 of APB Opinion Number 28. So we have to go back to APB Opinion 28 and look through paragraphs 23 through 29. That's what we're going to focus on now. What do these paragraphs state? Well, let's take a look at them. We are now going back, and you have to have books like this in order to get all this stuff. A book like this would have APB Opinion 28 inside of it, and I do have one. Okay? So what does paragraph 23 in APB Opinion 28 have? It states that each report of an interim financial... Oh boy. Paragraph 23 states that each report of interim financial information should indicate any change in accounting principles. But paragraph 23 does not define what a report of interim financial information is. So if you don't know what the report is, how can you indicate any changes in the accounting principle? If anyone has an answer to this, leave it in the comments below. Paragraph 23 continues by stating that when you indicate any change in the accounting principles, then you should indicate these changes in the comparable interim period of the prior annual period. So, from what I'm getting out of this is that if you make changes to from LIFO to FIFO or whatever in quarter 3 of that year, then you should make the same changes to quarter 3 of the last period, or indicated somehow in the last period, quarter 3 of the previous year. If I'm wrong, please let me know. This paragraph also states that you should indicate the change of accounting principles in the preceding interim periods of the current annual period. So, you would indicate these changes in quarter 2 and quarter 1 if you made the changes in quarter 3. Okay? The final thing paragraph 23 states is that you should indicate the change in accounting principles in the prior annual report. So you prepared accounting statements for the previous year. So let's say you're working on the accounting stuff of 2023. Well, you made an annual report in 2022, so you should indicate this change of methods in 2022's report. Now, what this paragraph fails to state is how you indicate these accounting principle changes. So let's move on to paragraph 24. Okay, so we're now reading paragraph 24. It discusses changes in an interim accounting practice, but it doesn't define what this change in the interim accounting practice is. It also doesn't define what changes in the annual accounting practice is. It doesn't define any of this. It doesn't say, do this, do this, do this. I don't know if the accounting textbooks do this. I hope so, because not there. Paragraph 24 also states what a policy made in an interim period is. I hope some accountant can enlighten me on this one, because I don't know what the heck they're talking about. This paragraph does state, however, that these changes should be reported in the accounting period where these changes were made. They wanted accountants to follow the procedures stated in APB Opinion 20. So now you're going from APB Opinion 28 to APB Opinion 20. What does paragraph 25 state? It states that certain changes in accounting principles, such as those described in paragraph 4 and 27 of APB Opinion 20, well, okay, you have to know what changes in accounting principle were described in paragraphs 4 and 27 of APB 20. So we're going to go from paragraph 25 of APB 20, Opinion 28. We're going to go shifting now to paragraph 4 of APB Opinion 20. So let's go there. Paragraph 4 of APB Opinion 20 states, APB Opinion 20 does not change the policy of the Accounting Principle Board that its prior or future opinions, unless otherwise stated, are not to be retroactive. I can only guess that the principles that were stated in these opinions shouldn't change the accounting practices that were conducted during past years of a company's financial record prior to the introduction of APB Opinion 20 or 28. These opinions were published at a certain moment in time, and if you read them carefully, you will find a statement about an effective date. That statement refers to when you should use the accounting principles described in the opinion you are reading. Until you reach the effective date of the opinion, you should use the accounting practice that you are already using. Hope you understood that. Then paragraph 4 briefly presents the topic of an industry audit guide, but it never defines what that industry audit guide is. But apparently this industry audit guide can prescribe the manner of reporting a change in accounting principle. But they never define how that would work. So let's go on to paragraph 27 of APB Opinion 20. This paragraph has a title. The title of this paragraph is Special Changes in Accounting Principle Reported by Applying Retroactively the New Methods and Restatements of Prior Periods. Wow, that's a mouthful. What does it state? Oh boy. It first discusses certain changes in accounting principle. It specifically references retroactive treatment in prior period reports. It states that the advantages of retroactive treatment in prior period reports outweigh the disadvantages of retroactive treatment in prior period reports. But this paragraph doesn't state how this should be done. So that's why we need a professional accountant to read all this. So this Accounting Principles Board recommends that the financial statements of all prior periods should be restated. This paragraph specifically focuses on the changes from LIFO to FIFO or some other change in accounting principle. It also focuses on change in the method of accounting for long-term construction type projects. Like you've ever done a long-term construction type project. Of course, this paragraph doesn't discuss long-term construction type projects. I wish it did. If you want to know what changes occur in a long-term construction-like project, well, you'll have to ask somebody because I don't know. And if you ever find out, leave something in the comments below and I'll see what I can do with it. The last thing this paragraph focuses on is a change to or from the full cost method of accounting. Like anybody knows what the full cost method of accounting is. And this paragraph doesn't elaborate on it either. I may have to elaborate on this in a future video. When would this full cost method of accounting be used? It would be used in the extractive industries. Like anybody knows what an extractive industry is. Well, of course, this paragraph doesn't state that either. See how this thing has holes in it? Now, we have to go from APB Opinion 20 to paragraph 25 of APB 28. We've already been reading it. So, now this paragraph 25 of APB Opinion 28 refers to paragraph 26 of APB Opinion 9. So now we're going to go from APB Opinion 28 to APB Opinion 9. Oh boy. Let's go over there and let's see what the paragraph states. This paragraph states that a discussion of prior period it starts with a discussion of prior period adjustments. That's what it does. It states that when you record these prior period adjustments, like we know what they are, there are resulting effects. What are these effects? It refers to applicable income taxes. So these resulting effects are are a result of the applicable income taxes, but it doesn't specify how income taxes relate to these resulting effects. It does say that the resulting effects of the prior period adjustments have an effect on the net income of your balance sheet. Well, that's all great and dandy if we knew any of the other terms. You see why this thing is so difficult to process? When it comes to interim financial statements, the net income of prior periods would be affected by the prior period adjustments. Okay, like we know how they are affected by these prior period adjustments, but we don't. All these adjustments have to be accounted for on your annual accounting statements. Okay, I'd love to account for them on the annual accounting statements. I know what they are, but how that's done doesn't say. All right. Now, what else does paragraph 26 of APB Opinion 9 say? It discusses financial statements of a single period. It says any prior period adjustment disclosure should indicate the effects of such restatement on the balance sheet of the retained earnings portion of your balance sheet. Like, I know how to do that. It specifically states that these disclosures should indicate the effects of such restatement on the balance sheet of retained earnings at the beginning of the period. Well, that's all wonderful, except I don't know how any of that's done. It should also indicate the effects of such restatement on the net income of the immediately preceding period. So, we know that the net income, let's say we're dealing with the third quarter of a business. So we know that the net income of the second quarter is going to be affected when we change the third quarter from FIFO to LIFO, but we don't know in what way. Okay, it doesn't give an example of the restatement. I wish it had. So we are still in paragraph 26 of APB Opinion 9, and it also states that when an accountant presents financial statements for more than one period of time, the disclosure of prior period adjustments should include the effects for each of the periods included in the statement, which I totally agree with, except for the fact, how is this done? Okay. It also states that prior period adjustment disclosure should include the amount of income tax applicable to the prior period adjustments. I agree with that, because when you make a prior period adjustment, your income tax is going to be affected, and so is your net income. The only question is, how are you supposed to do that? It's not illustrated. So, what else does paragraph 25 of AP... Now, we're going to go from APB Opinion 9 back to paragraph 25 of APB Opinion 28. Well, I think I've just about discussed all that I can do in this particular video. So, if you're watching this and you have answers to any of this, feel free to leave them down here in the comments below. I will tell you more in a future video, so I'd like for you to stay tuned.